Hi, Justin Butler here from Eclipse Financial Services, just with another in our videos on how the financial system works. Today's video is focusing on the superannuation and pension system. Whenever somebody looks to invest money, there's really two separate issues that you need to address. The first one is, what tax structure am I going to invest this money through? And that's what we're going to talk a little bit about today, with super and pension being one of the tax structures. The second issue you need to work on, once you've picked which tax structure suits your situation, is where you're physically going to invest the money. Is your portfolio going to consist of cash, fixed interest, property or shares? Today's video is not explaining how this works. We have separate videos on our website that talk about investment basics and how the investing markets work. Today we're focusing on tax structures. Effectively, there's only four major tax structures that are generally used in Australia. One is companies. So if you're running your own business, you may have a company, and companies pay a flat rate of tax of 30%. The second one is individuals. Most of us are generally lodging an individual tax return, which is either wages we're earning from our employer, or it's a distribution of profit from our company, or dividends, profit from our business or dividends from our company if we're running our business through a company. Individuals pay tax at different brackets depending on how much your taxable income is. And you still get the advantage of the lower brackets even if your income falls into one of the higher ones. So your individual rate can be as low as nothing if your taxable income is less than $18,200, or it can be as high as 47 cents in the dollar on the portion of your income that's over $180,000 for the year, if you're lucky enough to be earning that sort of income. Family trusts is another one, or trusts. Basically, trusts in themselves don't pay tax. They distribute profits or income to companies or individuals who pay the tax. But effectively, our video today is mainly on the super and pension system, which is one tax structure that the government have built and designed to help people build up their wealth for their retirement and then be able to draw down a pension from their retirement. Some very, very attractive rates of tax for the super system. So what we're about to explain is a little bit more about how that works. So basically, super is a system where you're looking to build your wealth up during your 20s, 30s, 40s, 50s and 60s until you get to a point, whether that point be, you might be lucky enough for that to be 50 or 55, or it could be later at 60, 65 or 70, but where you get to a point where you've built up enough wealth that you don't need to earn a wage anymore. You can stop working, start drawing down from your investment pot and investment income and use that to live on in retirement. Superannuation has two distinct phases to it. This build-up phase is called the accumulation phase, and the drawdown phase where you're taking a pension is called the pension phase. In broad terms, in the accumulation phase, a super fund only pays 15% tax on the interest that is earned, that is being reinvested to make your pot grow. In broad terms, once you've converted to pension phase and you're starting to take out an annual pension, your super fund will pay no tax. So that's a very, very attractive rate of tax. That in itself is an attractive rate compared to maybe paying the 32% or the 40% that most individuals are. So that's some of the carrot with super, some of the incentive, but there are also some negatives or some sticks with the super system. I guess the sticks are, you can't access your super until you're a certain age. It's 55 if you were born before 1960, and it's staggered between 60 and 65, and if you're born after 1965 you can't touch it until you're 60. So you need to be well aware of those preservation ages and make sure you haven't built enough and you're looking to retire but it's all in super and you can't get it for another 5 years. So you may build some wealth outside the super system as well. Some of the other things to be aware of, because of the attractive tax rates, there are contribution caps on how much you can put into super. Basically, what's called concessional contributions, where it's either salary sacrifice from your wage that your employer's paying in, or the compulsory SG contributions, they're capped in the 2015 financial year to $30,000, or maybe 35 if you're over 50 years of age. There's another type of contribution called a non-concessional contribution, which is money that you've already paid tax on. It might be from selling a property in your own name, it might be a term deposit or just some savings. And there's a cap of $180,000 per financial year that you can put into super of that style of money. And there are some intricate rules around bringing forward years and so on. So they limit how much you can put in because it's so attractive. When it comes pension time, you pay no tax on the interest in the fund. They force you to draw down a pension once you convert to pension phase. That starts out at 4% per annum through until from age 55 to 65. Then it ratchets up to 5% for 10 years, then 6%. Every 5 years it goes up 1%. Once you get into your 80s and 90s, they're forcing you to draw large amounts out of super. The idea of the system is that you're eroding your super balance and using it to live on, so you're not claiming as much from the government in age pension. Super's not something designed to be left to your kids. It's, you draw the money out, it might end up in cash, term deposits and shares or property that can be left to the kids, but you can't actually leave a super balance to your children unless they're financially dependent on you. So in summary, Australia's super system is very, very attractive. It offers some significant tax benefits to people looking to build up wealth for retirement and then draw down wealth in retirement. However, there are reams and reams of rules and legislation, so you should be very careful of what you do with the super system without getting advice from an appropriately qualified financial planner or an accountant who has specialist qualifications in that area. As mentioned, there's many other videos on our website, eclipsefs.com, covering different financial issues, and like all of the videos we put up, this is designed to provide you general information only, and you shouldn't actually make any decisions about your own financial situation until you've talked to a financial planner who can assess your personal needs and requirements. Thanks for listening.